What is up, everybody? I am going to be going over a very interesting announcement made by the conservative government when it comes to our tax-free savings accounts in this video. Now, this will not be a political video. Trust me, there is plenty of YouTube channels where you can get political information regardless of whatever party you are leaning for. I'm just going to focus on this TFSA top-up that the conservative government has proposed. I'm going to give my thoughts on it. I'm going to give some potential investment strategies, some potential hardships in terms of integration of all of this. I'm just going to go over this overall policy that's been brought forward and my overall thoughts on it. Obviously, we have no idea who is going to win the election at the end of April, so whether or not this makes it into place is definitely something that is up in the air right now, but there is a lot of people talking about this current top-up policy, and I just want to give my thoughts because I have had a lot of people ask me about it. But again, before I do, remember those 3 top Canadian stocks, which, I mean, could end up being pretty useful if this top-up does come into play. Those are in the description below. They're directly from my premium platform. You can grab them absolutely free. It takes just a few seconds. And I definitely want to hear your overall opinions that what you would do with this money if this account would come into place. Obviously, head down below, comment, let me know what you think, and like and subscribe to the channel, most importantly, to get more great content. The first thing I want to do is actually get into the video about the top up. I'm going to skip the start, the actual political portion of it, and I'm just going to go over the TFSA top up portion of it because I believe that is what is most important at this point in time, and then I'm going to give my thoughts on it. So let's dive right into it right now. Just to move this on a little quicker, I have this video at 1.5x speed. I'll drop a link in the description if you want to watch the entire video, maybe at a little bit slower pace.
So today I'm announcing the next step in my Bring It Home tax cut. Introducing the Canada First TFSA top-up. A common-sense conservative government will let Canadians contribute an extra $5,000 to tax-free savings accounts for investments in Canadian companies. Here's how it would work. Nothing about your existing TFSA would change. You would still get your normal $7,000 limit, which you can contribute and invest anywhere and however you like. What would change is that you could contribute an additional $5,000 a year as long as that $5,000 gets invested back into Canada, supporting Canadian companies that employ Canadian workers and pay Canadian taxes. The tax system already defines these kinds of Canadian investments. My government will create a definition that will let financial institutions and advisors tell you which investments can go into your Canada First TFSA top-up. It will bring home billions of dollars of investment and jobs to Canada while bringing home savings for you. Money will rush into Canadian businesses, who will in turn hire more people and pay more taxes, and it will help us become more self-reliant and sovereign as we stand on our own 2 feet and stand up to the Americans.
Effectively, what this situation will work out to be is you will have your normal TFSA, and then you will have an additional amount of contribution room that will be allowed to invest in Canadian companies. Now, there is a lot of intricacies when it comes to this, and I'm going to go over some potential issues I see with the actual rollout of this system. So the first issue I would like to bring up is the integration of all of this. Now, what exactly are they going to do? Are they going to leave it in your original TFSA and you're allowed to contribute extra money as long as that extra money goes into Canadian corporations? And the one reason I do not believe this will happen is it would be a logistical nightmare to actually employ. If you had a $70,000 TFSA and you topped it up another $5,000 and you invested that money into Canadian companies, how would they actually monitor this and regulate this? And for that reason, I do believe that if this rule actually came into place, it would be an entirely separate account. I believe it would be a secondary TFSA, and keep in mind, none of this has been confirmed yet, but I do believe it would be a secondary TFSA that you can invest in, and it would make it a lot easier for them to monitor the actual rules put in place. Now, depending on what rules they put in place, that would make the monitoring of these accounts either very simple or very complex. But that's one thing that I do believe, and again, it's speculation, will happen with this account, is it will be a separate TFSA account that you can open up, you can contribute, and you can invest in Canadian corporations with. Now, the second question I have is, what defines a Canadian corporation? Now, we could go on the basic element of it has to be Canadian traded and domiciled in Canada. But the thing is, the vast majority, or at least the vast majority of high quality stocks on the Toronto Stock Exchange actually do not have the majority of their business in Canada. I mean, if I could think of a few of them right off the top of my head, I'm going to go Shopify. They are a Canadian corporation. The bulk of their revenue is from outside of Canada, United States, globally, things like that. The second one I think of, and is going to be a very popular stock on this channel, is Alimentation Couche-Tard. They are a global operator. The majority of their business is operated in the United States. Actually, Canada would be one of the smaller segments of the business. It has larger presences in places like Europe, United States, things like that. Another one I can think of is TFI International. So they're a Canadian trucking and logistics company, but a few acquisitions over the last while have resulted in them actually generating the vast majority of their revenue in the United States. So much so that they actually wanted to redomicile to the United States, move their headquarters south of the border. So where do they draw the line in this? Would it just be Canadian domiciled stocks? Now, I imagine they would put in place rules that you can't own Canadian domiciled CDRs, or you could effectively just own US stocks via Canadian depository receipts that are offered by, say, BMO to a certain extent, or CIBC. I imagine those will be out of the picture. But the one key thing will be, how much Canadian exposure do you really need? I mean, I can think of other companies that I own. Let's talk about Boyd Group Services for, just as an example. This is a company that is a Canadian domiciled stock. It trades on the Canadian market. It's headquartered in Canada, but over 90% of its business operates in the United States. So if we create this rule and we allow the TFSA top-up room to be invested in companies like this, does it really help out the Canadian economy? I guess it would help out in a way because these companies still pay Canadian corporate income tax, but to a certain extent, does it ever help the economy really? Would they just be taking that investment capital that people are buying the shares from and expanding south of the border? I would argue yes, because the bulk of these Canadian corporations, they headed to the United States because it is a much better market, much larger population, much healthier consumer, much more GDP growth. So eventually they're going to head to the United States. So that would be another very interesting concept that I would look at, is to what extent are these rules put in place for Canadian companies? Let's say they have a rule in place that the company needs to generate, the majority of its revenue from Canada. So when we isolate out that element of it, we come to the conclusion that it's primarily going to be oil producers, grocery companies, things like that. I mean, I'm sure there's a lot of, Canadian companies that generate the majority of their revenue here in Canada that I just can't think of off the top of my head. But there's another element here that if we isolate it to that segment of the market, are we possibly isolating it too far to the point where investors won't really want to utilize this because of the overall lackluster results from companies who drive a ton of their revenue here in Canada? I mean, off the top of my head, I can think of a bank like CIBC that generates a ton of their revenue here in Canada. It has done quite well over the last while. That's an entirely other subject, for another video, but over the long term, its overexposure to the Canadian economy has actually led to overall underperformance in terms of results. And if we look to a lot of the Canadian grocers, I mean, outside of Loblaws, companies like Metro and Empire, who have a ton of Canadian exposure, they would definitely fall under that limit. They just haven't really produced all that good of results. And then we look to the Canadian telecom companies, which the vast majority of their businesses here in Canada, they've been very lackluster investments over the last while. So if we limit this to investments that are likely to generate jobs, that are likely to generate, revenue for the Canadian economy, GDP growth, we can think of gold miners, we can think of lumber producers, we can think of grocers, banks, oil and gas companies that really haven't provided all that strong of long-term returns. Does that deter people that don't necessarily want that exposure to the Canadian market because they believe it will be underperforming, do they just opt out of utilizing this anyway, open up a taxable account because their other TFSA is full, and then, just buying an S&P 500 index fund or US equities? Another added element here is this is more so a pitch to maybe the older generation here in Canada, or people who have been lucky enough to be able to max out their TFSAs when they're younger, because ultimately you aren't going to take advantage of this account unless your original TFSA is maxed. If you have normal TFSA room where you are not limited in any way as to what you can buy and sell, you're obviously just going to open up one of those accounts and buy whatever you want. So this would really only appeal to those who have their TFSAs maxed, which is actually a small percentage of the population, sadly, just because of the overall cost of living crisis that we're currently in. And ultimately, it's not really going to appeal to that many people. Again, I don't want to get into the politics of it. I'm just stating overall, this is really not going to appeal to that many people. If it does appeal to you, you're definitely on, a really good path. A lot of people can't afford to live, let alone max out their TFSAs. But if this is going to appeal to you, and it will appeal to me, it's actually going to really depend on the overall stipulations when it comes to this account. So that'll lead into the final element of the video I have here is, how would I actually spend this room if it was given to me? And again, that depends a lot on the limitations of that room itself. I'm not going to lie. Yes, I would utilize that room and buy companies, but the vast majority of my Canadian traded portfolio has very little exposure here in Canada. So I would probably be buying Canadian stocks that contribute relatively little to the Canadian economy overall, just because the ones that have exposure south of the border, they're just much faster growers. They're exposed to a stronger market. I mean, the Canadian economy has been well known for, we're going on 10 plus years now for some significant lackluster growth overall. So if there's no limitation as to how much Canadian revenue a company actually generates, I would definitely be opting for my current Canadian holdings, which do very little operations in Canada, the vast majority of them. Now, that said, if they did limit it to companies that specifically operate majority of revenue here in Canada, I would definitely still utilize that room. I would look to those grocers that have performed relatively strong. Typically, a Loblaw. I would look to the oil and gas producers like a company like Canadian Natural, Tourmaline Oil. There are plenty of options to own here in Canada that would produce relatively strong results, especially from a tax-free perspective, even if they were to limit it to Canadian, majority Canadian generating companies. And in that regard, I do actually feel that this rule would help the Canadian economy. The only difficulty here is how much does the Conservative government, if they get into power, regulate where your investment goes? I believe that's a fine line right there, and one that, could feel a little bit restrictive depending on how they go. If there is a rule, depending on the involvement in the Canadian economy, there's going to be a lot of Canadian stocks that maybe don't meet this threshold by a very small amount. They're going to miss out on probably a relatively large influx of capital that would go into Canadian stocks. And another thing that I may be questioning is the exchange traded fund standpoint of it. A lot of people are choosing to invest in ETFs over individual stocks. So if we go to the situation where somebody doesn't want to buy individual stocks, they want to buy a Canadian listed ETF, where do you draw the line? Even when we look to a fund like XIU, which is the TSX 60 index fund, it tracks the top 60 companies on the TSX. I got to tell you right now, the vast majority of the companies in the top end of that fund actually don't have all that many operations here in Canada. We're looking at Shopify, which is one of the top holdings. They have a ton of exposure south of the border. Canada is really not their main revenue driver, despite being one of the largest companies here. We can look to a company like Waste Connections, which is, again, a Canadian listed company that has the majority of its revenue is generated south of the border. You can look to a company like Alimentation Couche-Tard, which would be included in this as well. Huge chunk of revenue south of the border. We can look at BMO, the Bank of Montreal, which has a large U.S. presence. Where do they draw the line in that regard? That's going to be a very interesting situation. If the conservative government gets in, if they actually implement that, how they're going to do it with ETFs, or are they going to effectively force Canadians to be investing in individual equities? That's going to be definitely interesting and something I'm going to keep an eye on. Overall, this video is just kind of me, turning on the camera, filming my thoughts on this. Obviously, the election is far from done. If the Conservatives lose this election, this could just not be implemented, period. But it's definitely something that is an interesting point in talking about, and I figure I would make a video, relay my thoughts. If you guys have any thoughts on what you think about this TFSA top-up, drop it in the comments below. I'm really interested to see the feedback from whether you're left-leaning, right-leaning, whatever it may be, from a non-political standpoint, what you actually feel, the value that this will add, and if it's a good idea or not. And as always, head down below, like the video, subscribe to the channel, grab that report on 3 free stocks in the description below, and we'll see you next time for more great Canadian content.